Most luxury hotel investments do not fail because of one bad year. They fail because a series of structural decisions quietly cap long-term value, while financials still look healthy. Performance holds. ADR looks strong. The brand still carries weight. And yet, value creation has already stalled. This video is not about operational mistakes. It is about the hidden risks that capital consistently underestimates because they sit between strategy and operations. By the time they show up in the numbers, the repricing is already unavoidable. Many luxury hotel operating models are optimized for ideal conditions: stable staffing, stable demand, stable service intensity. But luxury assets are not tested in perfect years. They are tested under pressure. When labor costs rise, when staffing depth erodes, when service density must be reduced, margins compress disproportionately. Why? Because the cost structure was designed for peak optics, not operational elasticity. On paper, EBITDA sensitivity looks acceptable in the base case. Under moderate stress, it collapses. This is not cyclical weakness. It is a design flaw embedded long before acquisition. Many owners assume that a strong brand affiliation provides downside protection. In practice, brand economics are rigid. Affiliation fees are fixed. Standards are non-negotiable. Flexibility is limited. In softer years, this creates an imbalance: margin pressure without pricing relief. CapEx obligations without revenue elasticity. Standards that protect image, not adaptability. The brand may preserve perception, but it does not always preserve financial optionality. Capital often discovers this only after closing, when structural leverage has already been lost. Some luxury hotels operate on informal knowledge, unwritten rituals, leadership intuition, cultural memory stored in people, not systems. It feels authentic. It feels iconic, until something changes. When ownership transitions, when leadership rotates, when teams are rebuilt, the measurable impact follows quickly: longer onboarding cycles, wider service variance, inconsistent guest satisfaction, weaker rate justification across segments. What looked like cultural depth reveals itself as operational opacity. And opacity is expensive. The most overlooked risk in luxury hotel investments appears at exit. If premium performance depends on current leadership, current owner philosophy, or discretionary spend tolerance, then the exit multiple is not anchored. Buyers price uncertainty aggressively. This is how seemingly strong assets, with stable top-line performance, exit below expectations. Not because they underperformed, but because their value could not be cleanly transferred. Capital does not discount beauty. Capital discounts fragility. The real question capital should ask is not, is this a strong luxury hotel? It is, which parts of today's performance survive a change in leadership, ownership, or market cycle, and which do not? If that answer is unclear, the risk already exists. It simply has not been priced yet. Luxury assets do not lose value overnight. They lose it structurally, decision by decision, while the numbers still look fine. That is where disciplined capital wins, and where everyone else overpays.